Before I get into the tax architecture, I want to spend a few minutes on something that I think gets missed in these kinds of conversations. The base case for venture capital, irrespective of the tax treatment. If you look at the portfolios that are managed by the most sophisticated allocators in the world, will almost always have a significant allocation into private assets, somewhere between 35 and 45%, with venture capital playing a core role in those portfolios. And more now, we are beginning to see that kind of allocation language being used publicly by mainstream financial advisors. And there are very good reasons for that. Firstly, early stage private companies have essentially zero correlation with the ASX or with listed global equities. When the listed markets corrected, as they did sharply in 2022, a well-constructed venture portfolio is not going to move with them. And that's not because venture is safer, it's because the return drivers are completely different. With venture, you're investing into technology adoption curves and company-specific execution, not in interest rate movements or macro sentiment. The second reason why venture stands alone is the genuine need to diversify. The reality is that as more companies choose to stay private, some of the world's best companies, the most high growth companies, arguably the most interesting companies, just cannot be accessed on the public markets. There are now in Australia more than twice as many private companies valued at over $100 million as there are listed ones. According to JP Morgan, the public markets, the listed markets, are declining at the fastest rate in 25 years, and they're forecast to continue to decline into the near future. The public markets today simply do not provide diversified exposure to the true universe of corporate stocks. Even the indexes are now heavily dependent on a few major companies for their performance. Meanwhile, private markets have grown spectacularly over the last 2 decades, and they're forecast to continue to grow to 21 trillion globally by 2030. And when you compare this data side by side, what becomes very clear is that the investment markets are undergoing a massive global shift from public to private assets. And so, if investors want diversified exposure to the true universe of corporate stocks and where the next decade of returns are being built today, venture capital has to be part of your portfolio. And the third reason is return asymmetry. Venture capital operates under what fund managers call power law dynamics. Most investments in a portfolio will underperform or they will fail, but the ones that do perform well, the ones that work, can return 10, 20, 50 times the original investment. And that is very much the intention. So when SpaceX listed last week, retail investors were thrilled with their 20% increase at the end of day one trading. But the venture capital investors who backed SpaceX at the beginning made, in some cases, up to 100 times their money. Even taking examples that you're looking at here from our own portfolio, we've seen companies like Easy Collect deliver a 600% return to investors, 4D Medical delivering 295% return to investors in only 18 months. Morse Micro, that we currently still hold, which recently raised an institutional round at 500 million val, but at the time that our investors invested in Morse Micro, it was valued at 40 mil. That's a book value increase of 12.5 times. And there's way more growth to come with this company. It's just getting started. And these are not outliers. This is the way venture capital works. It is the model. The asymmetry is not available in listed markets. You cannot buy listed equities and expect these kinds of returns on a single holding because the market has already priced in the upside. But in venture capital, it hasn't. The most dynamic part of the economy, the part that creates the next generation of real wealth, is private. And in our view, a portfolio with no venture capital allocation is simply missing the most important part. Now, the good news is that we live in a country where more unicorns are built per dollar of capital invested than anywhere else in the world. And as the Australian innovation ecosystem continues to get stronger, that rate of growth and success of private companies is only likely to increase. It is also the case that Australian venture capital and private equity consistently outperforms public markets over the medium and long term, according to analysis conducted by Cambridge Associates. So the next generation of high growth companies in AI, in health tech, in climate, in defense, in advanced manufacturing are all being built right now, and they are being built privately. We believe that the next decade will deliver some of the most extraordinary growth in corporate value that we have ever seen, and that the great majority of that value will be generated in private markets. So the question is no longer whether venture capital should be included in a portfolio, but how.